So hello and good afternoon. I welcome you to today's special webinar, how to trade the market opening of the US markets. My name is Jens Klatt. I'm the Global Head of Research and Education at JFD Brokers. And today we wanna have a look at the market opening of the US markets, how to probably trade it. Last week was huge volatility, as you may have seen. Last week on Thursday, when I remember right, I was making a short trade on the DAX topic I was holding. And in fact, the market made lower lows there. And in fact, the trade turned out to be really nice and run profitable. Nevertheless, this week is showing some kinds of recovery, let's say. And in fact, yesterday, that's one thing we want to mention here. Yesterday wasn't a very nice day, in fact, because I was long, and in fact, so I was long the DAX here. And in fact, it turned out to be the right side of the market. Unfortunately, there was one coincidence, as you may have seen, with the US inflation coming in above expectation. Usually, right now, you wouldn't expect inflation data to be kind of market moving, to be honest. So it's only inflation data. So, but yesterday it was good for a very rough push here on the downside. That's, by the way, the S&P 500 on a 50-minute time frame. So the S&P, that was 1 hour before the spot market opened here, pushed aggressively lower, losing more than 40 points within minutes. And this resulted also in a quite aggressive drop here then in the DAX. And if you're long and you're seeing such a low volatile market environment, then you can imagine that so far the market was trading around plus minus zero. So that was no positive, no negative sign. It was just a break-even trade, and then you get stopped out in this stint on the downside and seeing the market aggressively turning higher. And I think it definitely makes sense to make this a topic here and find out what's the potential reason for this push here yesterday, and what does this probably mean for the upcoming hours. Then I have to say that, and that's something I want to bring up here right at the beginning. I think that the Dow Jones, but also the S&P 500, are both good for a continuation of this recovery, which started already last week then on Friday. So you can remember that was last week on Thursday. That was when the Dow Jones has seen last time quite huge volatility, dropped I think something like 800, 900 points here, and wasn't capable of making back the losses here. Lost aggressively again on Friday, and then recovering into the weekly close. Many were saying, well, this probably just a kind of a fake out move, or not a fake out move, a fake move in general, not a fake out, but a fake move here, and we are probably about to see a very, very volatile and aggressive push lower at the beginning of this week. Well, it didn't happen. In fact, the market was capable to stabilize, and not just to stabilize, but one second, please. I have to here. So it wasn't just capable of stabilizing the market, but it pushed, in fact, aggressively higher yesterday, and volatility, the VIX, the volatility index on the S&P, pushed quite aggressively lower. So one sec. So let's have a look here at the VIX. By the way, I just have a look here. Okay, everything fine. Okay, perfect. I just had a look here on the chat box, and as you can see here, there is the VIX, and the VIX is trading below 20 again. So, and continuing to drop here. Let's see what happens today. But all in all, I have to say, chances are higher, I think, that the volatility index will keep on falling here, and this resulting in a stabilization of the equity markets than the other way around, and the volatility picking up again. So that's one of the reasons why I definitely favor the long side today, and why I'm a little skeptical whether there's so much more potential here on the downside then. Nevertheless, let's see. I mean, we know we have a strategy, and this strategy is the open range breakout, which we'll make a topic a little later on. It's possible that we'll make a short trade, or a setup at least for a short trade topic here. Even though right now, again, we should definitely wait for the market opening, and I wouldn't be surprised to see the market trigger on the long side. By the way, if you scroll into the chart here, you can also see that we're about to see at least a quite significant region to be tested here, region of highs, which were marked last week on Wednesday. Yes, and we are capable of making it above that level. That would then make this potential double bottom look, in fact, as a turning point probably, and we have further potential on the upside. So in fact, when we're playing the long side today, when the setup is triggered on the long side, again, we have to wait for this, but nevertheless, if it happens, then we're definitely looking for a break of 2,725 here. With a push higher, we could easily make another, well, 20-25 points on the upside, I think, on an intraday basis here, and that's that's currently what we're looking at. Nevertheless, before we start through here, again, I just have to look here and look at the DAX. Okay, currently stabilizing. That's, by the way, interesting. Just to give you an idea of what I think right now. Even though I'm positive for the U.S. equity markets, there's still slight hope that there will be pressure. So it's a systematic trade I have on, which is one on the short side again. So this hasn't changed, and I have already traded my stop to break even, which is currently around 12,450 points or so. And let's just see how things go from there. So currently, the main target of this trade is, in fact, and that's the level I'm looking at, it's 12,385. So if U.S. equity markets really come in weaker and can't take on positive momentum here, but push lower, there's a good chance that the DAX will probably see another attack here at this level, the current daily lows. And if we push below that, I mean, what you can see here is a solid support, 12,000 and around 370 points. Nevertheless, if we fall below that level, there's probably further room, which could easily push us another 50 points lower or so. On the other hand, we have to say, well, that was something we've seen last week on a minute time frame, to be honest, those 50-point movements here. Nevertheless, that's the current level I'm looking at, and where I'd then probably get a little more aggressive with my exit management and probably diverge a little from my systematic approach, which usually says keep the position open till the end of the day. Yes, till the end of the day. So, in fact, that's definitely something to look at here. And nevertheless, right now, I think chances are higher that I'm getting stopped out break even though I will keep the position on and just see what the US markets deliver here. Now, let's have a look at what happened yesterday and how to interpret this. I think it's very important to do this. Some might probably argue and say, well, really, is it necessary to interpret such a move? I mean, the market just fell and then recovered sharply. Nevertheless, it's a quite aggressive move on the downside, and I think it's definitely worth to have a deeper look here at this, because it's giving you some kind of feeling what the market probably sees right now. For me, it's very important to have a or to get a feeling about what is the market reacting to, and how does he react to this. And I mean, you can come up with every technical explanation why this happened, whether it was the Bollinger Bands here to narrow, and then a volatility breakout was likely to happen. I mean, in the US equity markets, that doesn't really matter, because this is not where the main volume is traded, but it's here in between those two gray vertical lines. This is where the spot market opens, and that's something you can understand here in this context the same way. So I have those two lines here, those vertical lines, to just show where the main trading takes place, the main volume comes into the market. But when looking, for example, at the DAX, well, what we can definitely say is that the market yesterday here has seen a really calm, and it was so calm, we haven't seen this for quite a while, at least for 1 week. So that was just like crazy. There was no volatility at all. Market was really trading in a very, very narrow range. And so, okay, someone would argue now, well, it was a volatility breakup. But I think that doesn't make sense, because when looking at the markets and when to try to get an idea of what's the current sentiment and what's driving markets and how does the market react to certain news, I think then it makes definitely sense here to draw a line over to the economic calendar and there at the inflation data, which was coming out. By the way, I just want to show you our JFD research website, where you have a quite good economic calendar. What do I mean by that? Well, it's not the most detailed one, but this is in fact something I consider to be really positive. So probably you've seen economic calendar. So by the way, I'm sorry, that was a little too fast. So we are currently working on a separate URL, but currently you have to go the way jfdbrokers.com, and then you click here on research and education. That's the German website. If you switch this to English, then you'll see that it's research and education here, and there you can click on JFD research. And if you scroll a little, again, it's very compact. It's not a huge calendar. By the way, you have to wait a second here, and then you can see it. But the thing is, and that's the positive thing about this economic calendar, I think that here, if you have less information, it's way more you need what you need as a trader. So you probably have seen economic calendars which are overloaded with every data around the globe, like I don't know, Brazilian GDP. I'm not saying that the GDP from Brazil is probably not interesting, but for traders, especially trading major markets like major currency pairs like Euro USD, dollar Japanese yen, or something like that, well, here it's definitely true to say, well, Brazilian GDP probably does not play such a big and huge role, and this economic calendar is really, it's a really compact one, and so really bringing down the top events here respectively. Yesterday, you can see that sometimes there's some more data included here. That's probably, for example, on the crude oil inventories and that stuff. But the thing is that what you can see here is then CPIs coming out at 1:30 p.m. GMT, and they came in above expectation. Plus retail sales disappointed. So this is then the other side. It's not very detailed, so probably it makes more sense to then use a website here, which is called tradingeconomics.com. If you look at those data, especially when interpreting them afterwards, so to get a short overview of what's important for the markets today, you can check that, such an economic calendar, and then if you want to do some research, yeah, you definitely write on this website, tradingeconomics.com, completely for free. You can find indicators here for countries, which in our case is the United States, G20 in this case, left column, and there we go, and we have the inflation rate right here. That was the data yesterday, and as you can see, no big surprise, in fact. So stabilized at 2.1%. So no big deal at all, even though when scrolling down a little, you can see that the consensus could be found here at 1.9%. So it came in above expectation. But I think this is not even the big deal here, even though this push higher in inflation resulted in a quite aggressive push higher in the yield market too. So therefore, I just want to show you another chart. Don't want to get too detailed here, so I just show you a retweet of mine in my Twitter account, so that you just have an overview here. One sec. It's where is it? So here's a development of several yield curves. It's really nice. Nevertheless, it doesn't get the job done. What we want to see is how the market reacted in terms of yields here to this news event. And as you can see, Euro USD, for example, pushed aggressively lower. By the way, we pushed below 123 around 1 day ago, so that means 24 hours. We're currently trading around 125. So obviously the market reversed aggressively. That's, by the way, something we want to have a look at in a few minutes then here. Why is the US dollar so much weaker? And on the other side here, you can see the treasury yields and how they reacted to this data set here. So it was aggressive push higher, even though you can say that it doesn't look that much. I mean, it's a tick chart, and as you can see here, we pushed higher from 2.82 up to 2.87, let's say 8.87, and this is 5 basis points. It's not that much, but you have to consider the depth of this market. So this is in fact a very, very big move. And so as you may recall, last week, what we made a topic here, and also mentioned was, what's the reason, what's the driver for US equity weakness here? And one main driver, which was argued, and I think it's definitely fair to bring this up, is that yields shot higher. So the development in general, what we've seen in yields over the last days and weeks here, definitely is a good reason to mention, or it's definitely a good way here to argue why the equity markets came under pressure. That's mainly due to the fact that there is huge leverage in the market currently. Okay, so therefore, let's have a look here at Google, and there we'll have a look at NYSE leverage. NYSE leverage. And there's also a website which is showing you the margin debt. And currently, and based on developments around central banks over the last years, and you may recall several political debates and not TV shows, but news around this topic here was mentioned, debates in general, where people were saying that central banks are manipulating the markets and flooding it with liquidity, which rather soon or later will result in problems and all that stuff. And so what you can definitely see is that obviously margin debt right now is at all-time high levels. And margin debt means nothing more than you're buying with cheap liquidity available. And if yields rise, well, liquidity gets expensive. And then if liquidity gets expensive, and you have seen a huge positions built based on margin here, as for example, around 2007, 2008, shortly before here, the financial crisis then hit the markets. Well, that's usually definitely something to worry about here when yields rise to a certain level and cross a certain threshold here. And that's, I think, the perfect explanation for what happened here. But now the thing is that yesterday the result was initially as expected. Markets went lower. Why? Well, because yields shot higher, and that was exactly what the market is playing here. So you can see that the market reacted as expected, even though I think the reaction is a little too aggressive, because, I mean, I don't see a reasonable justification for a market dropping something like 50 points here on a data set like the inflation data yesterday, even though thin liquidity is definitely good for such a push on the downside. But however you see it here, it's a fact that the market recovered quite sharply afterwards, and not just recovered those losses, but made significantly new highs. It's not just the S&P, but also, for example, the DAX, even though we have to say, okay, one main driver here for the DAX was definitely US equity markets. But let's come back here to the S&P. So what's happening here? Why is that? And especially have a look at, for example, Euro USD, probably even more important. So you see equities rising while you also see US dollar being sold off. So initially, the US dollar reacted positive because yields shot up and made it more attractive to invest in the greenback here. So you can see that the market lost within minutes, seconds, in fact, lost more than 70 pips, but to recover all of these losses after and then taking really off. And all in all, I think most of you probably can already see what I'm after at here. So why is that? Why is the US dollar so weak, and why is the equity market shooting through the roof? I think the explanation one should give here is, or we should definitely look at, is that the market is now betting on the Federal Reserve probably to step back in the terms of in their step back from further rate hikes in the future. So therefore, we have to remember, even though it's a little difficult to interpret those charts here, but let's nevertheless try it just to give you an overview. So we're looking at the CME right now, and there's a tool, we call it the Fed Watch tool. And this Fed Watch tool shows you how probable, how likely the market thinks it is that the Fed will hike rates at a certain date. For example, here, March 2018. As you can see, over 80% are currently betting that the Fed will hike rates by 25 basis points. And I have to say, I definitely agree. So I think that even though yesterday data disappointed, especially around the retail sales, does not justify not to hike rates in March. But more interesting it is that in June, for example, as you can see, this is, by the way, the current level here, 125 to 150 basis points. That's the current yield level. What you can also see is that the market is already betting with more than 60% probability that in June there will be another rate hike. So it will be with more than 90% probability at least one hike till June. It's more likely to get to see two hikes here when looking at the Fed Watch tool. Then we look at September, and you can do the same thing again. So we're after two hikes here. So meaning after a third hike, we would come out somewhere between 200 to 225 basis points. And as you can see here, probability that we get to see such a third hike in September is already 45%. And if you do the same thing here for December again, you can also see that even though it's only 25%, there is nevertheless 1/4 out there, market participants expecting to hike the Fed to hike rates 4 times in 2018. So now, if the inflation data comes in above expectation, while retail sales disappoint, this is the backbone of the US economy, and with also knowing that there is a quite aggressive flattening in the yield curve in US yields here. So 2 years yields are shooting up, while 10-year yields are stabilizing, or at least are not as fast rising as the short-term yields do. Well, what does this show? It shows that short-term market participants expect the Fed, in fact, to hike rates. Well, no big coincidence or big surprise, because look at those graphics here from the Fed Watch tool. That's obviously what these charts are telling us. And nevertheless, for the long term, they think that there won't be such a restrictive course from the Fed. Respectively, there is no such strong economic development which justifies rising yields in the future there. And such a flattening in the US curve shows that the market is obviously expecting a recession, somewhere forming on the horizon. And with this in mind, you can perfectly understand, I think, what's happening right now. So the market yesterday was driven higher in EUR/USD, so US dollar was aggressively sold, mainly due to the fact that the market, or the US dollar, which had already some trouble to profit from the Fed being the most restrictive central bank in the G10 currency universe here. So I mean, we have the US dollar, which is currently seeing a yield level at something between 125 to 150 basis points, and this is in fact at the same, close to the same level of the Australian dollar, respectively. It's just one further rate hike away from reaching the same level, nearly, as the New Zealand dollar. Both currencies are known to be high yield currencies due to their connectivity here to the commodity sector, and usually seeing higher level or higher yields here in general. So it's obvious that the Fed is by far the most restrictive currency central bank here in the G10 currency universe. Nevertheless, from last week onwards, last year onwards, and after the election of Donald Trump, which initially pushed US dollar higher based on the speculation around fiscal stimulus and tax reforms, so cutting taxes and all this, the market couldn't take on further momentum here, but started to really lose value. And that was, I think, mainly due to the fact that the market participants right now see the likelihood given that the US will rather sooner or later see a recession. And so now that means nothing more than the US dollar has probably some further room to go on the downside, mainly due to the fact that market participants really expect, if at all, 2 rate hikes in 2018. So if there is the statement coming out then in March and the Fed hikes rates by 25 basis points, and there is a communication which indicates that there will be probably one further hike in 2018. This is, in fact, currently, when you look at what the market is expecting, super dovish and should result in US dollar staying under pressure. So, and Well, US dollar being under pressure, and obviously the Fed being looser in their monetary policy, or in the relation to what the market expects. Well, what does this usually mean? It means nothing more than equities have further room to rise on the upside. So I think there's no real question about it that this was the main driver why the Dow Jones yesterday rose in value and was capable of taking on that strong momentum here, respectively the DAX, why it rose higher here and pushed above a quite significant resistance, which can be found here around 12,370 points. So, and with this in mind, what you can see is where the conclusions you can get out of this is, I think, the following. First of all, the market currently is feared about rate hikes, respectively. Let's say yields rising and keep on rising because of the margin debt we see in the market currently. So we should be really, really, really careful if yields keep on climbing. That could rather sooner than later result in another quite aggressive drop here in the equity markets. By the way, I was discussing with my colleagues here. You can find their articles on JFD Research again. So yeah, when you look here, you can see several languages. So most of the time, the German articles are from me, while those English articles are from a guy called Pambos. 1 second. This is he here. So it's Charambalos, but we call him Pambos, and he calls himself Pambos too. And it's also Darius, who are writing those pieces here. And I had a discussion with both of these two over the week here. And while we were discussing, I said, well, you know what I expect? I think that the market has a good chance to see probably some kind of stability. So we're talking about US equity markets. So probably stabilizing now, probably the US equity market, in this case, Dow Jones, has a good chance to probably rise again here up and above 25,000 points, currently making it above this level. And then we probably see some higher volatility on an elevated level, even though I think in the upcoming months, especially from late summer and autumn onwards, I could imagine really the market to turn aggressively lower. And probably it's no big coincidence that especially, and there's another very interesting thing here, probably you've seen it, it was on the header here on Bloomberg again. It's a big deal. In fact, everyone is talking about this. I'm not sure why, but hedge fund king Ray Dalio. So hedge fund king. Not sure whether he's he likes that to hear hedge fund king, but I mean, at least Ray Dalio is the manager of Bridgewater. And Bridgewater is the biggest hedge fund in the world. They are having a huge bet on against Europe, and in fact, I think that. When looking at the overall picture, I think Europe, especially European equity markets, are probably more likely to lose aggressively than the US equity markets. Because if we get to see volatility in the US equity markets, as last week, for example, you have seen that the market pushed aggressively lower, yes, and we lost quite huge here. Nevertheless, we didn't make it below the simple moving average 200, which you can see here in blue. So we're still in a bullish market environment. That was just like taking a breath or so. Well, no big deal, in fact. When looking at the DAX, for example, you can see that in the DAX, we pushed below the 200 simple moving average. And this push below this level here, in fact, now is probably turning the tides, let's say, and definitely negating the overall bullish picture which we can draw on the DAX, even though some might argue that everything above 11,900 points is still bullish. Well, I somehow agree, even though I don't want to be aggressively long anymore. If I had long positions on in equities, for example, I'd definitely start to at least buy insurance. Even though probably start to reduce my equity long position here in DAX related equities, based on the fact that we fell below the simple moving average 200 quite aggressively, by the way, and are not, as last year in August here when we pushed below that level, are making it back immediately, but stabilized below that level right now. So this is a clear sign that there is something on the horizon which is definitely something to fear about. And I have to say, again, that's a long-term view now. I have to say that the market has probably some potential here to stabilize at an elevated level, even though I think that at the end of the year, probably summer, late summer and autumn, there's a good chance that we get to see further volatility, similar to the one from last week, probably even higher volatility, and that especially European equities could aggressively turn lower. So yeah, with this in mind, that's perfect. Here, a question: can we look at gold? Sure, we can, because gold is definitely worth to have a deeper look at. Because I have to say, based on what I just presented on the equity markets, I have the feeling that gold has a long-term positive outlook here, and I'm very confident that it's not taking very long till we see at least another attack at the current yearly highs around 1,365 USD per ounce, but also push above that level and then push towards and above 1,400 USD. So short term, I made several days in the past, I made potential long engagements in gold topic. So what we've seen here, first of all, from the highs of the year, we've seen a structure of falling highs and falling lows. And then I said, that was at the beginning of the week. Oh, no, not necessarily, in fact. It was the beginning of the week. I'm sorry. Yes, it was. So we've seen a first attack last week on Thursday that the market tried to make it here above this region around 1,320. That was the last relative high, I think, which can be identified here. Meaning, if we trade above that level, then the structure of falling highs and falling lows is at least interrupted. When the market started strong into the new week and pushed above these highs, which were made here on Thursday, that was a sign that the trend now can be considered broken. And I said every pullback that was last week, this week on Monday, every pullback towards former highs is potentially a good long trigger. In this case, 1,320. We pushed slightly below that, but took off from there, made new highs. I did the same on Tuesday. Said everything around 325 is bullish and the potential long trigger. We took off from there, worked out again. Now, with yesterday, I mean, the market took off, even though it seems to be very optimistic to expect someone buying here around 1,330 USD per ounce and then not placing the stop here at this level. So it's likely that someone got stopped out here on this push yesterday, even though from a pure a research perspective and from a structure, we did exactly what we expected to happen. That the market, gold in this case, will take off again and push towards these highs here. And again, if we make it now above 1,367 USD per ounce, these are the highs here, 366. I'm sorry. This is definitely a clear bullish sign then. And we target on the upside for 1,400 USD and probably even higher than that. So yeah, that's it. That's it on gold. Now, what we want to have a look at is the US market opening. So that's definitely interesting to watch. I love to see that. I have to say that. Why? Well, as I said, I have a position in DAX on, short position. So I love everything what is weak in the US equity markets. I mean, at the end, it doesn't necessarily mean that here that the DAX is losing ground too. In fact, currently it does, but nevertheless, it's not sad. Correlations are something very special. Wow, this is great. I didn't. Well, that wasn't planned. You have to believe in that. But I just want to invite you to a webinar. It's not from me, but from my colleague. It's Stefan Friedrichowski. He has a PhD in physics, and he's today holding a webinar on correlations in German, but I know that he will hold the same presentation in English too. So you can find this also via jfdbrokers.com, and then here, research education, click on events, and there you have all events listed taking place here. And there you can see this. This is the German title, and as you can see here, Friday, tomorrow, it's correlation in the FX market, chances and risks. So if you click on this, you can see here, that's Stefan, that you can register for this webinar. Just come to the website and probably have a look here at those correlations. Probably this is something which is definitely worth watching here in this context. I just want to make long things short here. So the reason I said this is, well, if I trade the DAX, I usually don't look at the S&P in this case. Nevertheless, with the US markets opening now, it's definitely it makes sense to look at the US equity markets. That's all I want to say. And so yeah, so it's very interesting. In fact, I mean, it's very difficult for me. So you can see that you have to be open to the market conditions here. Well, I'm short. I want the market I want to see it fall apart. I just want to see it crash now, similar to last week on Monday, and everything would be fine. I'm short again. Nevertheless, I'm very, very skeptical if this is really a lasting move, or it's probably only just a gap close happening here. Meaning, as you can see here, the red line, this is the highs from yesterday, and the turquoise line, this is the first tick now at 2:30 p.m. GMT here. So this is when the spot market opens, when Wall Street opens. So when the spot market comes in and volume starts to surge, and so probably it's only just a gap close taking place here. Let's just wait. The great thing about the open range breakout setup I do want to present to you here is that you have to wait till 3:15 p.m. GMT. So meaning 40 minutes from now. Till then, we don't take any action. We only wait for the open range to be defined between 2:30 and 3:15 p.m. GMT. And if we define it, meaning we take the high and we take the low of this range, we from there then go in direction of the identified advantage once the market breaks out of this open range, which means we are using here 15-minute exponential moving average 10. So trading in direction of the identified advantage, meaning everything above the EMA 10 here is long, everything below is short. I will give you an example based on yesterday, which worked out pretty well yesterday, in fact. And then we trade the break of the open range in direction of the identified advantage. As already said, that's the third step here. We put the stop above, respectively below the high and low of the range. There we go. So let me just give you an example here, how this looks like. So yesterday, and therefore we want to use probably purple line. So this is the low. In fact, it's the green line. Okay, so we never made new lows from there, and this is the high. So I'm taking this candle. It's when it closes, it's 3:15 p.m. GMT, and well, obviously we are trading above this yellow line. The yellow line is the exponential moving average 10, as you can see here. And that means the moment the market triggers here, we're going long. This is what we just do, and place the stop below the range, which is here. So this is the low in between 2:30 p.m. and 3:15 p.m. GMT. This is where we place the stop. So meaning we have an entry long, 2,669.25, and place the stop at 2,638.39. Now we might say, well, this is quite a lot. I mean, we're talking about a risk here of 30 points. This is the great thing about having the chance to reduce the position size accordingly. Micronization, for example, so you can trade CFDs at JFD, for example, as low as 1 micro lot here. So a one point move in this, or no, this is a little difficult to say for the S&P, but let's take the DAX as an example here. So 1 point usually accounts for €1, but with the micronization, you can go as low as 1 point equaling 10 cents here. So micronization. And that's in fact possible then. And as you can see here, the trade then is closed somewhere here at the end of the trading day at 9:50 German time. So it's 8:50 p.m. GMT. The trade is taken out, and as you can see yesterday, trended aggressively higher, and so you were capable of profiting from this push higher in the S&P then yesterday, for example. So this is the example of how such a setup works out. And so what we're currently doing is we now wait again for those 3 candles to develop here. So the highest 17. In fact, we right from the start traded lower. Nevertheless, we have to wait. Still have to wait. It doesn't make a difference now if we place those orders here. We wait for this to happen, if we trade above the exponential moving average 10, we're going long. If we trade below, we're going short. And that's in fact the setup. Now you might say, well, really? And this works? It does. It does tremendously good. Therefore, just let me show you a chart here, which was also done by Stefan. We held a webinar together. That was also last year here on FX Street. And we made several strategies a topic, and the open range breakout here was one. And he had some trouble with his internet connection. I took a screenshot then. I just did it just to be sure that if his connection gets lost again, that I can then take over without any problems. And just in the moment, it was probably 2 seconds later, after I took the screenshot, he was gone for several minutes. Nevertheless, I never deleted this screenshot because it's perfectly showing the equity from November 2010 till June, July 2017, last year. And as you can see, it's obviously a rising equity curve. It's a very simple setup. It's easily duplicable, which is great because that makes things very easy for you. You can just write down your parameters, when to enter the trade, when to exit the trade, and then just trade through this. And by the way, the strategy can also be automated to some extent. And yeah, as you can see, it's working out pretty well. You have a win rate of 47%. You have an average profit of 1.08 and an average loss of 0.82. This is equaling to a payoff ratio, which is the average loss divided by the average profit divided by the average loss. It's coming down to 1.3 to 1. And the expected value of the strategy is that you're making 8 cents on average for every euro you risk. So meaning, let's say you're trading 100,000 euro account, risking 1,000 euros. That means an expected value of 0.08, that you're making 80 euros per trade on average. It doesn't matter if it's a winner or a loser, and obviously showing that the strategy is profitable. And yeah, so in fact, as you can see, the strategy works out. It takes discipline to just go with this strategy, even though it might look very, very easy and not very difficult. It's not. In fact, it's not. But the thing is that most people fail the moment to really trade through the strategy, not intervening from a discretionary standpoint. So therefore, let me just get again back here to my DAX trade again. I will show you. I will try something. The problem is that it's costing me tons of resources to open the MetaTrader right now. So I'm not very sure whether the connection here is still stable after I open the MetaTrader. But just let me show you probably the trade itself. It's something people are definitely always very happy to see then. Even though it does make a difference. So this is awesome. Really great. Nevertheless, what you can see here, I traded the stop to break even already. You can also see here it's a live trade. So it's here, quite big account. So I'm managing clients' money, clients' funds here. And so now the thing is that you might wonder, intervening in a strategy, okay, does it make sense? Doesn't it make sense? Well, it depends. The thing is, if you have a clear set of rules you're following in your trading, it definitely makes sense to follow these rules and not to intervene here because of some feelings or something like that. So in fact, what I did here is strictly forbidden. I've trailed the stop to break even here, even though you can see based on my input, my research at the beginning. Some might wonder, well, what does it make? Why is someone trying to find reasons to be long or trying to find reasons to be short? I mean, we're talking about identifying an advantage. And what I do here is nothing more than say, okay, you know what? I mean, if I consider the long side to be the long side, the side where the advantage can be found. Even though from a statistical standpoint, today is a short day. Okay, that's I mean, this is the overall approach I'm trading with. Nevertheless, the thing is that I say, okay, you know, I think the problem here is then that if you really don't believe what the market is telling you based on your experience, that's something you take into account then here. Well, it definitely makes sense, in my opinion, to trail the stop then, to break even, get out of the risk here of the trade, and then see what happens. In fact, what I can tell you is that based on this approach, I run the same strategy on a demo account in a basic version. So I'm not intervening in this demo account here. This is the live account where I intervene. And now the interesting thing is that my results show that I'm performing quite well, at least in, let's call them silent or normal market conditions, under silent and normal market conditions. That means, yes, last week, for example, I performed really horrible under these huge volatility. And in fact, the strategy itself turned out a huge and nice profit, even though I didn't score that positively as the basic strategy did. So I scored profitably and I made money last week trading, which is already a very good sign compared to many, many others there. Nevertheless, the thing is that I could have performed even better if I just stick to the strategy, to the basic strategy I'm trading here, which I didn't, based not just on my personal experience, but here also because it wasn't that I had fear, that I was anxious or something like that. That's definitely the wrong way to put it. But nonetheless, I was very, very skeptical, especially about this low liquidity we've seen in the market, and the market really jumping and jumping, meaning here jumping 100 points within sometimes seconds. And that was something where I really said, you know what, let's play defense here. So you have to stay in the game here. You can't, I mean, we're not talking about huge volatility in terms of the equity curve itself. So because I'm playing defense here, it means playing it more defense or defensive than I usually play it already. Nevertheless, I think you get my point. And so what I want to say here is the following. If you do this, if you intervene here, your target should be, if you know the overall expected value, the overall average profit, and the overall average loss to trade, what you should do is to really try to improve these numbers to make the profitable trading strategy even more profitable. So my target here is to increase the hit rate, respectively to increase the average profit, respectively the average loss. So meaning nothing more than just to assume the following. The market now, currently trade is showing a profit, nice profit and everything, okay, cool. Nevertheless, just imagine that the market now turns around because there's aggressive buying coming into the US markets. We have seen this several times in the past, and it's also, again, not unlikely that probably here the volatility keeps on falling and the Dow Jones here making it back towards the levels around 25,500 points, the starting point of the sell-off from last week on Monday. So this happened several times. So just imagine this will happen. And now, I mean, again, the DAX is positively correlated. It doesn't mean that the DAX will shoot through the roof, but it's likely that it will happen. So what will happen is usually that the market takes off from here, and it's then probably not just pushing towards the starting point of the day, but on top of that, making it above the highs and probably pushing aggressively about 12,500 points. Now, let's assume that I'm taking out my trade at break even and the DAX shoots higher again, and the basic strategy closes out the trade with a loss. That means I have gotten out of the trade with plus minus zero, even though some might say, hey, why don't you take the win then? Or why don't you just cash in the chips here? It would even be better. Yes, I agree. Nevertheless, you just can't see whether the market will probably turn lower from here again. So you don't want to take the chips from the table and now seeing the market crash 150, 200 points now. And see an even higher profit then, which would be generated. This is something which would affect your expected value negatively. Okay, so that plays in two directions here, and you have to be on the right side. not just once, but several times. This is the next thing. But what I want to show you is that if I take out the position then here and the market really pushes aggressively higher, it's probably a good way then, a good sign for me to just say, you know what, I take out the position, and if the market really turns higher from there, and the basic strategy shows a loss, I increase not only my average, or I reduced my average loss in this case, and increased my hit rate, but this is also having positive impact on my expected value overall. And something which, in fact, a profitable trader is looking at, and a professional trader is looking at. This is what trading is about. It's optimization of the expected value. Sounds a little difficult at first, even though I think it makes perfect sense to say, well, if I know that my strategy is profitable, as for example here, this basic strategy in the S&P, and I then find actively reasons to somehow increase the average profit and reduce the average loss, based on my experience, based on filters I work with, whatever, well, this is increasing the expected value, making me even more profitable, and it's exactly what I should aim on when I trade the markets. And I want to trade profitable, and even more profitable than over a quite long period of time. Yeah, and so that's why I'm showing you this here. And let's just see how things develop. Then I will now here close the platform again. So because of the resources, again, the interesting thing is this is a potential reason for support. So I definitely should take into account here. I definitely take into account here more aggressive exit out of the market, even though I have to say there's also some further potential probably for another 40, 50 points, as already said at the beginning of this webinar here, on the downside. And that's mainly due to the fact that here probably the S&P will then start to close this gap. So that's also interesting. So we pushed aggressively higher yesterday already, and so the market probably is a little exhausted. I'm not saying that we now will turn around here and aggressively crash or something like that. No, it's just like that. I think, well, probably buying power will diminish, and we get to see a gap close first before the market takes off then. And with this in mind, and knowing about the positive correlation between the DAX and S&P, that's probably some room that this gap is closed and the DAX can dip another 40, 50 points on the downside. And that's why I'm currently at least a little relaxed and around taking potential profits here. So yeah, that's it. 1 second. Okay, so I'll just want to have a look here whether you have some questions. It's a system trade. It's based on a systematic approach, which is generated automatically in the morning. So the question, where did you get in the case of the DAX? It wasn't because of any formation or something like that. It was just it was in fact a time stop in, if you want. It's not a time stop out, but it's time stop in. So you tell the market or the system, go long, let's say 7 a.m. And the market goes long because you found out that there's a pattern repeating over and over again. With taking also by identifying the overall advantage here, which is then showing that you're trading with a positive expected value. So that was based on the systematic approach here. Are there any other further questions? Other markets probably. So we had a look at gold here, for example. Okay, EURUSD. I think EURUSD is in fact very extended after yesterday's push, even though again I'm very skeptical about the US dollar. So let's call it, let's put it that way. If we get lucky, I think then there's a good chance that probably EURUSD can make it back towards 123.80 here. So 124, 123.80. That's 100 pips from the current levels, and as long as we do not push below 120, 150 to 122 here, I consider the overall mode to be bullish. Nevertheless, below 125, I consider the overall mode bullish with a neutral touch here. But I try to get in around 124 and then look for a break above 125.50. So try to anticipate a break here on the upside. That's what I would go for if the market comes back again. Now, the thing is that this is the question: does it really come back, or it probably shoots higher? Currently, I have to say, it's not very unlikely that the US dollar keeps on pushing lower, and that there's a good chance that probably we get to see the break above 125.50 before the pullback towards 124. Yeah. Any other questions? Else, I'd probably would say that probably we'll see again the next week. If you're interested, again, that's something important to note here. If you're interested, just give us also or hit the subscribe button. I think this is how you say this today. Hit the subscribe button on the JFD channel. So there you get a notification about all webinars taking place. We have quite broad and huge load on information here on the markets every day. It's not just me giving the morning meetings here every morning, 10:30 a.m. GMT, but it's also some technical outlooks here from Darius, for example, from the GFD research team. So yeah, just give us your subscribe or your subscription, whatever, on our YouTube channel, JFD Brokers, and then you have the chance to see plenty of other webinars and streams and live streams, short versions. Yeah, next week, sure. Next week, 2 p.m. GMT, we'll meet again here and cover the market opening of the US markets. Again, what we have to wait for is this open range to be finalized. And currently, it takes another around 20 minutes, around 20 minutes, 15 to 20 minutes until we have a high and low defined here. Again, then the breakout occurs in direction of the identified advantage, meaning we're trading above the yellow line, we're going long, we're trading below the yellow line, we're going short. That's it. So that's the setup. And yeah, if you're interested, well, we can definitely have a look here at this setup then next week, if you wish. Happy trading. Watch your stops, and to talk to you again then next week on Thursday, 2 p.m. GMT. I definitely look forward to it. Yeah, have a nice day. See you, and bye-bye.